Howard, what an important transition point for this economy. As you've pointed out, peak growth is here potentially, and we're about to make this transition from recovery to expansion. Howard, as a market participant, how do you think about that dynamic? How important is it?
Well, first of all, it's been, I think you have to say that we can argue about the amount of stimulus, what the Fed's done and all the spending, but it's been very successful. The economy is rip-roaring. And this is the quarter where we will transition from recovery to expansion. And we don't know the exact day, Jonathan. Maybe it's today. Maybe expansion has just begun this morning. I don't know. But the outlook remains sterling in terms of growth. You're looking at 6% plus growth this year. We haven't seen that in this country since 1984. After last year, we had negative 3.5% growth, the worst growth since 1946. And next year, we're looking for a slowdown to around 4%. We haven't even had that for 20 years. And so the stimulus and the reopening of the economy is providing a tremendous lift. And I do think, you were talking about the bank lending earlier, I do think you're going to see the demand for loans pick up. It has to, given what's going on in the general economy.
Howard Ward, you talk about the rocky road ahead. We had a lovely move here coming out of this expansion, and you are enthusiastic, but you talk about a grind, and you talk about a rocky tape. What am I in if I'm enjoying a rocky tape day to day?
Well, I would first of all just make the point that typically in the second year after you get the big advance in the market coming off a bottom, that second year usually is much more muted. You know, think returns in the sort of 8 to 12% range, not the 20 to 30% range. And if you went back and compared the current trajectory of the market to what happened coming out of the '09 bottom, we've been following that path very closely. And if we do continue to follow that path or that script, then we will have a hiccup or two in the next 6 months. Because in 2010, after a surging market in 2009, that's exactly what happened. Now, that market still closed higher in 2010, and I think it will be nicely higher this year, particularly so because I think even more so than in 2010, the earnings outlook is truly remarkable, to say the least, because while the consensus earnings expectations would be for growth of about 30% this year and 13% next year, so $182 on the S&P this year, 205, 206 next year. Tom, if you look at the first quarter earnings that have been reported, the annualized run rate on those is around $200. And so that would suggest that the consensus earnings numbers for both this year and next year are materially lower. They could be substantially higher. And so I do think that, yeah, I think we're going to have a rocky tape. We've seen that a little bit. Rates are and should be grinding higher in tangent with an economy this strong and with some heightened inflationary fears. And it's going to be that grinding higher interest rates that creates rocky tape. But beyond that, the outlook remains very positive. I would not be too cute in trying to trade this market. It's too early to turn your back on this bull market.